The information and opinions expressed in this video are of a general nature and are not intended to be investment advice, research, or recommendations. Please consult your investment professional for your own circumstances. The information in this video reflects the opinions of Arca Labs and the video's participants on the date of production and are subject to change at any time without notice due to various factors. Arca Labs is separate and unaffiliated from any third parties participating in the video presentation, and Arca Labs is not responsible for any third parties' products, services, or policies.
Welcome to Tokenization Talks, powered by Arca Labs. I'm Annelise Osborne. Arca Labs is focused on innovating responsibly. We are excited to bring you institutional thought leaders in the digital asset space. Our guest today is Lilya Tessler, who leads Sidley's FinTech and Blockchain Group. Lilly has numerous accolades, including Band 1 Practice and FinTech Practice Group of the Year. And Lilly, also you founded Digital Asset Regulatory and Legal Alliance. And I feel that you touch most everything that happens in the digital asset space from a securities perspective. So thank you so much for joining us. I really appreciate it.
Great. Thank you so much, Annelise, for having me here today.
So there's so many different things we can talk about that fit within your umbrella with securities regulation. But I would love to start talking about kind of the secondary market. And so I would love to get your input on how you see securities trading on the secondary market and what we need to do to bolster this ecosystem.
Mm-hmm. Great. No, happy to talk a bit about that. And a lot of my experience comes from being a regulatory lawyer in traditional securities markets, as we saw traditional securities markets that were paper and floor stock exchanges on the floor to digital traditional securities being more electronic in nature over the years. And now we're seeing the same evolution where the same traditional assets are being tokenized using blockchain infrastructure and also trading in a digital manner. The considerations is in the blockchain space is how the existing regulations under the Exchange Act with the SEC and also FINRA rules will translate to blockchain-based securities, especially tokenized traditional securities that are now recorded on a blockchain ledger.
So how do you see, so you're talking about differences. How are they different, right? What's the difference of if I transfer my private placement to John versus me transferring my digital asset private placement to John?
Mm-hmm. A lot of it is being able to directly interact on the blockchain and transfer the assets wallet to wallet from one party to another, as opposed to utilizing a central ledger that a transfer agent may maintain on behalf of the issuer, or the issuer maintaining its own centralized ledger in a digital form or even a paper form of who the holders are of their security. And by allowing for that blockchain-based recording of the initial issuance, the secondary trading makes it very more interesting and exciting, because anyone who had bought into a traditional private placement typically holds it and can't find another buyer or seller until there's some type of exit opportunity with the issuer. While by tokenizing the asset and allowing it to be supported on secondary markets, alternative trading systems, or even over the counter by broker dealers, it opens up a secondary market where anyone who buys a private placement, assuming there's a secondary exemption that's applicable, can sell it to another buyer before any type of exit option that exists.
So it's a great opportunity. And is it being done today?
There are a lot of, or several consortiums that have implemented certain preliminary use cases for tokenized securities, very early stages. So trying to do test cases on initial issuance, and the market infrastructure for secondary is still developing. So I think, it's a chicken and the egg problem. Is a lot of institutional investors and issuers are hesitant to tokenize their security on blockchain because there's no infrastructure for secondary that exists. At the same time, the secondary market is starting to develop, but it's not as developed, and there's still not the same trade flow opportunities that exist in traditional securities markets. And so until those are developed and resources are dedicated to getting more regulatory certainty and clarity from regulators, there won't be as many tokenized securities and the cost associated with doing so implemented.
So there's a lot. I do recognize there are some digital securities that are securities that can trade on the tokenized or on the secondary market, but there's not a lot of them. And so that's kind of where I was going. I remember back in 2018 and 19, there were a lot of panels on secondary trading, and then it just didn't exist yet. And so now it's still not a norm. So so how do we get there? So we set out the market, you have like the buyers and sellers, right? You have the buy side and the sell side on the primary market. So we can create a sell side. What about that buy side? Like where are we? Because I feel like that's not really happening yet from from an institutional perspective, or even if we go down in regulation to kind of like the family office, kind of broker dealers, almost retail, but accredited investors. So how can we move it along to help develop the secondary market?
So for buy side, often the buy side are bigger institutions, some of which are registered as investment advisors with the SEC under Advisors Act and have certain custody rule requirements where they can only maintain securities with a qualified custodian. Qualified custodians include banks, broker-dealers, transfer agents. The issue in the tokenized security space is there are a number of, at least one bank that may be able to hold tokenized securities. There's certain state chartered trust companies that have that regulatory approval, but there are no broker dealers yet that can custody digital securities. And this has been the topic of conversation, one that I've been advocating with the industry and with regulators for many years now, that there needs to be guidance under the customer protection rule on how a broker dealer can custody digital securities. I wrote back in 2018 a white paper on frequently asked questions that need to be answered under the customer protection rule. And in December 2020, the SEC put out a special purpose broker-dealer statement that provides a path for broker-dealers to seek approval with FINRA and the SEC for a standalone broker-dealer that can custody digital securities. And it's actually tailored towards something like this, where it's a tokenized version of a traditional security. It specifically doesn't allow for non-security digital assets within that same broker-dealer. But now it's been almost 2 years since that statement has come out, and there has not yet been anyone approved by FINRA or the SEC to be a special purpose broker-dealer. So that just highlights the lack of market infrastructure to support an asset such as this on a tokenized basis for the institutional market.
So first, how many? Well, I guess a lot of, because from a custodian's perspective, like there's how many custodians can actually hold securities?
So, because there, like I mentioned, there's bank custodians. There's Anchorage Digital, who's an OCC national trust. There are a number of state chartered trust companies, some of which are NYDFS regulated that can hold tokenized securities. But it really depends on the asset as to how it can be supported by some of these custodians. Certainly, they're regulated by bank regulators that also have a stringent oversight process for supporting new assets. And so it really depends on what blockchain the asset is on. Whether it's public, private, and whether there's infrastructure from a technology and operations perspective by these custodians to support a particular tokenized security. It's not a conversation we typically have with issuers as to doing diligence on what blockchain they support, who are the service providers that can support it before they decide to do a private placement. But now we're doing a lot of diligence and guiding our clients through that process at the early stages.
Yeah, I bring that up because there's so few qualified custodians, right? It's very limiting as to who can actually custody digital asset securities. And so then a question of, and we deal with this all the time. We have, in essence, consulting different funds, et cetera. And it really, the different parties in the ecosystem need to all accept a certain blockchain, for example, like you were saying, so that we can, talk on public or private. But going back to custody, how do we what do you think is the next steps for actually broker dealers being able to custody? Like, what's the holdup there? Do you anticipate it'll happen within the next 12 to 18 months? What do you think? What are the hurdles?
Yeah, so I'm representing actually a number of clients that are part of the FINRA application process for special purpose broker dealer. And without going into specifics, there are a number of questions, and this is the first time FINRA is interpreting this special purpose broker dealer statement issued by the SEC that they need answered from the SEC in order to approve some of these applications. Another area. So I guess for that, it depends how long it'll take to get those questions answered and get those that have been in the pipeline for quite some time approved. The other avenue is we've seen in public speeches from the SEC's chair and other division heads just trading in markets that there may be other additional custody guidance in the works at the SEC. And to the extent that will address some of the market infrastructure issues for broker-dealer custody, and I don't have a lot of insight as to what that will be. That could also be a path forward once that guidance comes out and the industry is able to review it and implement it swiftly. There could be more infrastructure developed thereafter.
So public and private chains, you had mentioned that before. So are your different companies that you're working with, do you find that they favor others? I mean, to be honest, I'm hearing that most of the institutions are looking at doing, some of them are open to both public and private, but it's obviously difficult to take that to a secondary market because you have to have the ATS and exchanges that all accept whatever that whatever that chain is that they decide to build on. Are you getting feedback on that issue or ideas of how that will be solved?
Yeah, so it's definitely an issue we talk through with our clients about and raise sometimes for the first time, because often some feel that using a private permission blockchain gives them more control from a compliance perspective, regulatory considerations. Maybe the regulation will be more comfortable because you can determine who's supporting the nodes on that blockchain and ensure that there are institutions that also have policies and procedures in place with certain regulations. But not a lot of those private permission blockchains are supported by the secondary markets currently. A lot of the ATSs that are in the market, they're all non-custodial, so you still need to find a custodian that can support holding the digital asset or tokenized security on behalf of the institution. But even if you do, the ATSs typically only support certain types of blockchains, and then often the issuer may integrate a transfer agent, and the transfer agent may only support certain types of blockchains. So that all needs to be considered if you're using a private permission blockchain. The public blockchains also have developed their own like for example, Ethereum has an ERC version of a tokenized security that allows for integration and controls for transfer agents and secondary trading that are effectively permissioned in nature as an overlay to a public blockchain. So that we're seeing that being utilized by clients as well.
Okay, so on the secondary market, it sounds like one of the holdups is fixing issues in the primary market, which is building out the ecosystem for consistency, and then being able to counterparties to be able to work together, right, depending on chain. Mm-hmm. So exciting news in the last few weeks that we have had some announcements. I think the private market is going to be the first that really addresses blockchain and embraces it more, because the public market's a bit more efficient. And so we have some tokenized funds, some large asset managers that are announcing they're doing tokenized funds. So do you think this is opening up the secondary market more broadly? How do you think that will affect, or I guess, can you share your thoughts on tokenized funds that were once, I guess, limited in opportunities of who could actually participate, to opening it up more broadly to the market?
So I think it's great to see some of the tokenized funds in the market as first use cases. Certainly the tokenization of funds or other traditional assets in the initial offering will give rise to secondary trading and more use cases in a liquidity perspective. Still, the traditional securities laws apply. So if you tokenize a traditional fund, it can only be traded on the secondary pursuant to exemptions from registration. And a lot of the secondary markets, ATS in the market, have controls in place that allow for only certain accredited or QUIBs, depending on the exemption you're using, to be able to buy and sell those assets. But I think that is definitely a use case that's ripe for primary issuance now and could develop a market later. It also provides more transparency in terms of the market and exit opportunities I mentioned earlier. For anyone that wants to buy into a private fund, but they may want to exit or trade into another fund down the road on a secondary market.
So from a global perspective, with the tokenization of the funds that are happening in the U.S. asset managers, Do you anticipate this is going to open up the market more broadly and offer more opportunities outside of for non-US investors, or how do you anticipate this changing?
No, definitely. There's global opportunity for tokenized securities generally, and I think the U.S. and the U.S. market structure here is a little behind compared to what we're seeing developing in other countries that are embracing this technology. I've worked, I think, dating back maybe 2018, 19 on some of the first tokenized funds outside of the U.S. That weren't offered to U.S. investors out of our Hong Kong office and Singapore office. We saw a lot of interest for tokenized fund shares out of Asia as some of the early use cases. And now it's great to see some of that being brought to US investors in the US market. But I certainly see a lot of growth and demand on a global basis for these types of instruments.
Great. And so who do you think will be the first movers to build out that secondary market? Because that's what we really need, is more people stepping forward, working within the regulation to do that.
Yeah, so I think in this area, this is an area where there's a lot of cooperation among different market participants. We're not seeing one financial institution step forward and say, we're going to be creating the entire ecosystem. A lot of it is partnerships between bigger financial institutions, emerging technology companies that have the technology, some that have the regulatory approvals that are needed, but really want to partner with the bigger investors, the bigger institutions that have the investors that they can introduce to this new tokenized security asset. So I think the consortiums are going to be the winners here, and we're already seeing multiple consortiums develop to support different types of tokenized securities.
Great. So I did want to ask, that is a little bit off base, but SEC enforcement. So this week we had a celebrity come out that was fined recently from promoting different things within the ecosystem. Do you see more SEC enforcement? And if so, kind of where do you anticipate that happening?
So definitely SEC enforcement, they've been active for a number of years. A lot of the early enforcement actions that we saw were against potential unregistered securities offerings in the digital token space, as to whether or not they were unregistered through the 33 Act. More recently, and over the years, we've seen the SEC enforcement focus on intermediaries. So unregistered broker-dealers, unregistered national securities exchanges that might be supporting assets that are securities. And then the recent enforcement action that you mentioned really talks about promoters, also a spinoff of an intermediary needing to register and not violate securities laws. So I think we'll see more of that on the enforcement front, although the messaging we're seeing from the SEC is they want to be more proactive and engage on the registration front. And I have had clients embrace that and come in proactively, meeting with SEC Chair Gensler's office, meeting with CorpFin, trading in markets, to figure out how can we come into compliance? Where are the areas that we need more guidance so we can help support building the infrastructure instead of navigating enforcement inquiries when we just didn't know what the regulations were. And recent conversations I've had with the chair's office and the staff in the various divisions have been very open to that. I would say more open than in prior years, in wanting some of the market participants to come in and work with the regulators on a compliant path forward. And I'm hopeful we'll see more of that in the future.
Okay. And then on the same line, you spent a lot of time with the SEC and with regulators. Are there certain themes that they're pushing on right now that you think will be addressed sooner than others?
Mm-hmm. So the themes, certainly as to whether or not certain crypto assets need to register as securities is an ongoing theme. I think it's, as I have said in other avenues and in amicus brief I recently filed on behalf of the Chamber of Digital Commerce, I think it's important in those discussions to distinguish the investment contract, which is a security in a lot of respects, from the digital asset, and understanding if that digital asset separately is or is not a security, or how the SEC views that. That's an area that I think would be a good area to have more guidance. And as the crypto asset disclosure regime is being developed, that's an area that I think we could see more guidance on. Custody is another theme that we've been hearing in public speeches, and I understand the SEC is working on some type of custody guidance. It's unclear if that's going to be for broker dealers, if it's going to be for registered investment advisors under the custody rule, that's an area of guidance that advisors need to understand on who's a qualified custodian, how they can comply with the rule. Oh, I think all of that is all right for more proactive themes that we'll be seeing. And then also how intermediaries can register with the SEC as national securities exchanges and ATSs to support this tokenized security asset class generally.
It's great. No, this has been fantastic. I really appreciate you taking the time on this. You've given me a lot to think about, and it's exciting to see the progress that is being made to move forward. And I think even in the next year, even though regulation is slow and typically reactive instead of proactive, which is what it's built for, we are making strides. So, and I appreciate all that you're doing with all of your clients to, move it forward. So.
Great. No, thank you so much for having me here today. And I really, think it's really important for this tokenization talks and for you to continue to have dialogues with different market participants and hear views and talk more about these issues. These are really important, exciting area that we're getting into in this space.